Okay, today we're going to take a look at a couple things dealing with the markets. The first thing we're going to kind of look at is investing cycles, and just want to kind of show some graphs based on how things were at the end of the 90s and then the early 2000s, and then looking at today. Also want to take a look at the valuation of the US stock market, and then finally talk a little bit about where I see that headed and what moves I'm going to be making here in the very short term for client portfolios. So it's one of those things you always hear the statement, everything that's out of style eventually comes back into style. So I'm still waiting for all my clothes from the 1980s to come back in style, because I've basically kept them all and just waiting. Can't wait. So then I'll be totally in style. But what this first chart shows is the total returns for various asset classes from 1997 to 2000. Remember the good old days when the stock market was just rolling up as technology was all the wonder of the world? Well, you can see over this 4-year period, the NASDAQ, the S&P 500, and the Dow Jones did very well here in the US. But when you looked at other asset classes outside of the US, the results weren't quite as good. Certainly you had some countries that looked pretty good. Here you can see Sweden, Switzerland, India. They did pretty well, but a lot of countries over that same 4-year period had negative returns. And even some asset classes, if you note here, the gold miners index was down 65% over that 4-year period. So if you were invested in tech stocks, the S&P or the Dow, hey, great, awesome. But if you were invested in more commodity-based holdings or countries that are focused on that, you actually had negative returns. So it's one of those periods where diversification really didn't help you out too much. You needed to be in US stocks, and everything else was just not up to par. Well, of course, we know what happened in 2000. The tech bubble burst. And this chart basically shows you what happened from 2001 to 2007. So here again, you look at the Dow, S&P, and NASDAQ, and those returns really aren't all that great, especially compared to the previous chart. But if you look at some of the asset classes and some of the countries that did the worst from that 97 through 2000 period, and then you look at it here post 2001, they did fantastic. Indonesia, the gold miners, which were down 65% over the 97 to 2000 period, up 512%. Same with Brazil, India, South Korea. All of those countries had booming returns relative to the US markets. So basically, since 2011, we've kind of seen a repeat of what happened from 97 to 2000. So you see here the NASDAQ, S&P 500, and the Dow, once again, doing very, very well. A few countries doing pretty good, Switzerland, India, Hong Kong. But for the most part, if you were diversified, if you had a diversified portfolio, it certainly didn't perform nearly as well as a US-based portfolio. And here again, as I mentioned before, look at the gold miners from that 97 to 2000 period. It was down 65%. Over the past 3 years, it's been down 70%. Now, are things going to turn around here over the next 5-6 years? And the gold miners, as well as commodity-based countries like Brazil and Chile, Norway, are they going to do very well? And we're going to see the US not do as well? Well, it's one of those things you have to look at valuations. Typically, as an investor, you are rewarded for buying things with low valuations. It's kind of basic common sense, right? If you buy a car, and this car, you buy it for $40,000, or you buy the same model for $30,000, and that car will run for 100,000 miles, you're getting a much better bargain, obviously, if you can buy it at 30,000 as opposed to 40. Same with assets. The stock markets work this way. So right now, most people feel comfortable in US assets because they've been doing so well since 2011, really since 2009. People want to be in US markets, but that doesn't mean that it's a good place to be. And you have to look at valuations. This chart kind of gives you an idea of what the valuations are for various countries based on the CAPE. Now, what's the CAPE? Well, the CAPE was developed by Nobel Prize winning economist Bob Shiller, and it stands for cyclically adjusted price to earnings ratio. So what this is, it's a price of the market divided by the earnings. And Bob Shiller did this over a cyclically adjusted period of 10 years. And how the way he adjusts it is he takes the earnings from all those 10 years and adjusts it by inflation. So what this gives you an idea is, based on the past 10 years, how is the stock market currently priced? And Bob Shiller was able to look at current CAPE values and give you an idea of what the future 10-year returns are going to be based on the current values today of the CAPE. So you can see here, if you look at the United States all the way to the far left, pretty expensive, really expensive. In fact, it's only been more expensive in two periods, 1929 and 2000. But you can see some countries, Norway, South Korea, Singapore, Finland, New Zealand, they have a much more reasonable CAPE value. This chart is also overlaid by the dividend yield. And as you may or may not know, it's between 30 to 40% of your total return in the stock market historically has come from dividends. So obviously, the better the dividend yield, the better your return is going to be. So what you'll notice here is the countries that have the lower CAPEs, the lower price to earnings ratios, typically also have higher dividend yields. And that kind of makes sense that if the market is beaten down a little bit, if it's a little bit cheaper, then the dividend yield's also going to be better. So you can kind of get a feeling here that, hey, nobody knows what the future is going to hold. And the thing about the CAPE and any other kind of valuation metric, it's a very poor indicator of short-term results. For the next 1 year, 2 years, who knows? But over a 5-10 year period, these valuation metrics tend to be a pretty good predictor of what your future returns are going to be. And if you listen to any of my webinars or any of my writings, anything like that, I've been saying that US stock markets are still very expensive. Now, this chart is very, very busy, lots of little dots. But what it's trying to show you is looking at that CAPE, that price to earnings over a 10-year period, and comparing it to the 10-year treasury, we can kind of get a feel for the valuation of stock markets. So the little red dots are the current price to earnings. And you can see there, we're looking at a price to earnings. Really, right now, it's over 27. But at the time of this chart, it was at 26.4. This was in July. So you can also see in the orange, that was the price to earnings from the period 97 through 2002. So that was basically the tech bubble. You can see we've never had valuations that high before, and we haven't since. The only time valuations got above 30 previously was in 1929, and of course we know what happens after 1929. Of course, the Great Depression. But if you look at where we're at today, at that 26, 27, we're still at awfully high valuations historically. Like I mentioned, it's really the third highest we've ever been. But what's interesting about this chart also is looking at the 10-year yield. So usually when you have 10-year yields below 3%, which we do now, you'll see the price to earnings based on the CAPE is typically below 15. So when interest rates are low, that low, below 3%, it's typically a difficult time in the economy. Rates come down that far because of either deflation or just not a whole lot of economic activity, and rates are coming down to basically show a slowing in the economy. If you also look at rates above 7-8%, you can see that the price to earnings of the market is also very low there, because what that's saying is we're having a different kind of issue. You have typically higher inflation. So with higher inflation, you have higher yields in the treasury. So stock prices typically aren't inflated because people they can sell stocks and go and get a 10-year treasury yield at 7, 8, 9 or higher rate. So you typically have less risk than stocks. So that's why you can kind of see the valuation of stocks are down. Valuations for the stock market, according to the CAPE, usually are much higher, from that 3 to 4% up to about 6%. So even based on treasury yields, we're at a very high valuation according to the CAPE. Some other things that have me very concerned about stocks in general, and this isn't just the US markets, it's the entire world. What you want to have, if the market is going up, you want to have a lot of participants getting to new highs. You want a strong breadth of stocks reaching highs. You don't want to have a small percentage of stocks that are leading the market. You want everybody kind of participating in the party. Well, this chart shows you the number of stocks in the US stock market that are trading above the 200-day moving average. And you can clearly see, essentially from April on, we're starting to see this number decline. So we haven't had a big decline in the US stock market yet, but what we are seeing is that fewer and fewer companies are leading the charge, and that's not a good sign for the stock market overall. Another little chart that kind of shows the same thing is a market divergence chart. So this is just the percentage of companies hitting their highs and companies hitting their lows. Anything above 5% here is usually a bad sign for the market. You can see the whole problem back in 2008. It went above 5% at the end of 2007. And right now, since 2015, we've been above 5% for the most part, except for a short period. Right now, we're well above 5% at about 5.7%. Now, this isn't certainly a foolproof metric. You can see in 2013, we had a false signal. I went to a lot more treasury bonds in 2013, turned out to be a bad move for performance, because I kind of expected a downturn that never came. So again, this doesn't mean that something's going to happen, that there's going to be a bear market around the corner, but of course, it's not a good sign. Usually, as I mentioned, anything above 5%, not a good thing for the market. Another kind of headwind for the market is what they call the smart money. So these are institutional money managers, mutual fund managers, hedge fund managers. And what this chart kind of shows you is they have been selling stocks. They were going from the beginning of 2015, we were looking at mutual fund managers having between 85 to 95% of their money invested in stocks. And right now that is clearly in a downtrend, and we're at about 48% of the smart money is holding stocks. So not a good sign. Doesn't mean that bad things are going to happen, but it's certainly something to think about. And I'm looking to make some moves. As I've kind of mentioned, you can go to my website and see the video I have on there talking about the 200-day moving average. I kind of use that as a guide to if an equity asset class breaks through the 200-day moving average, I'll go to short-term cash or bonds and just kind of wait it out. I do sort of watch the convexity of the 200-day moving average. So if it still has an upward climb, I might not get out. I wait for it to kind of be flat or negatively curved before I'll get out. But there are some holdings I am going to get out of right now. The first one I should have got out a long time ago, and I know it. It's master limited partnerships. Master limited partnerships, it's a tax structure where they have to distribute 90% of their profits to the shareholders. Most of these are oil pipelines. There's some shipping companies, there's some energy infrastructure companies, railways, but for the most part, you're talking pipelines. Historically, MLPs have been very much tied to interest rates. Because there's such a high yielding investment, they tie to interest rates, because if interest rates go up, master limited partnerships will come down because people can go to bonds, get a better yield with less risk. So what you typically see is a strong correlation to interest rates. That has not been the case in 2015. They've been tied more to the price of oil, which is heading down. At the time of this webinar, it's we're pushing 40 per barrel. So for whatever reason, the market so far has been punishing MLPs, pricing them as a product of oil, and that's just not the case. MLPs get paid for moving oil from point A to point B. We haven't had a decline in the amount of oil being used in the economy, so there hasn't been a fundamental case to see the decline that we have in MLPs. But I'm kind of throwing in the towel here, even though MLPs right now are yielding about 7.5%. And anytime MLPs have yielded 5% more than the 10-year treasury, every time that's happened in the next 12 months, MLPs have had a positive return. But that's usually based on the historical relationship with interest rates and not so much oil. Oil could continue to go down. I mean, I've even starting to see things talking about $20 a barrel, even 10. So if that were to happen, I think MLPs would continue to get punished unfairly. So I'm going to be selling those in short order. I do expect to get back in. I do like MLPs for the long term. I think it's 7.5% for the investor who can kind of shut their eyes and just ride it out. It's a great investment. The other thing I'm selling are REITs. I probably should have sold REITs earlier when it broke through a 200-day moving average. But again, interest rates, they're very interest rate sensitive, and I still expect interest rates to at least hold steady or maybe even go down. So I think it could be a good environment for REITs, but if you look at the charts right now, they did have a good bounce. They went up to the 200-day moving average and then kind of are starting to fall back. So they tested the 200-day and falling down. So I think I'm going to just sell and sit back and watch things. I'm also getting out of all the emerging markets. They're very heavily tied to the price of commodities, most emerging market countries. They're below the 200-day moving average, so it's time to get out. I'm also getting out small cap US. It has gone below the 200-day moving average. And typically small caps, if we are going to experience a market downturn here in the US, small caps lead large caps. So probably going to sell that. Developed international, meaning Pacific and European developed countries, I'm holding it for right now. I've got a short trigger on it, but I am going to hold those. And I'm also holding large cap US at the time of this webinar. It's still above the 200-day, but not much. So those are kind of the moves we'll see. I think over time, we will see that investing cycle where the US probably is going to underperform many of the world's asset classes, other equity asset classes. Don't know when that's going to happen, but if history holds, I think we're going to see some countries that haven't performed as well the past 4 years to sort of lead the market. But that may not be right now. So again, I appreciate you listening. You can sign up for my monthly newsletter, which includes all of these webinars as well as other helpful information. You can find it on our Facebook page. And then if you go to YouTube, Kirk Kinder, you can see all of these videos there. I do appreciate you listening. And if you have any questions, you can also contact me through these channels to find out what my answers will be. So thank you.